Hi everyone, James here. Today we're going to talk about how to invest with little money, $100 or lesser every month. But before that, let me share with you my own story first. Alright, so throughout the past 20 years, I've had many friends or ex-colleagues asking me about how to start investing as a complete newbie. And despite all the time and advice I've given them, only a handful of them really took action and get started investing. I think one of the biggest obstacles that they face is that they believe investing requires a large amount of capital to get started. But that's not true. Alright, you can start investing with just $100 a month or even lesser. In fact, if you invest $100 every month with an annual return of 8%, which we'll dive into that more later, in just 30 years, it will grow to an impressive 135,000, out of which the money that you deposit, that you put into work is only 36,000. So the difference of 99,900 is actually what you got back as returns or profits. And that's a whopping 277% ROI. And I'm pretty sure this can help you achieve your retirement goals or any financial goals that you have in mind. And you may be thinking, how on earth do I get such a good 8% interest rate? By smashing the like button and subscribing to my YouTube channel right now so I can teach you on how to invest for the better. And not to forget our favorite financial meme. Okay, jokes aside, the key is to educate yourself on the various investment options out there. Do your own due diligence and see what type of investment suits your risk appetite and time horizon. With that, I'm going to walk you through 4 main ways on how to invest with $100 or lower in Singapore, as well as their pros and cons. Alright, the option that we have is endowment plans. This is one of the very common ways many people have heard of, the typical endowment plans. For those who don't know what endowment plans are, that means you haven't stepped into the shopping mall enough to see all the insurance agents of freebies or enticing your kids with the giant bouncy castle. And you know, when I go to the shopping mall and my son tells me, "Hey, Baba, I want to play the bouncy castle," I will always tell him that, "Hey, then I will need to sit there for an hour." And he must be thinking, "Wow, good ma, then I can play for the 1 whole hour." Okay, then again, right, I have been in their shoes before, those insurance agents, working as a personal banker in my early days when I cannot find any jobs out there. And that's real tough work, because those who need to go down to the road shows in the shopping malls are those who are not able to meet their, their targets, their sales targets, and they have to chiong during the weekends, despite already working so xiong during the weekdays. So, to be honest, my heart really goes up to them on this, and I wish them all the best. All right, but anyway, enough of my own, small story. Back to the definition of endowment plans. Endowment plans are a type of insurance policy that combines protection with your personal savings. All right, the policy holder, which is you, pays regular premiums over a fixed period of, say, 10, 15, or 25 years, and the plan matures at the end of the term. One of the big benefits of endowment plans is that they are relatively low risk, and a lot of them have those guaranteed portions, right? So that means they say they promise you maybe 100,000, out of which 60K may be guaranteed amount. So making them quite suitable for conservative investors, especially those who don't want to take a lot of big risks. However, there are also 3 big reasons why so many people are shunning away from endowment plans. So first of all, these plans typically have a fixed term. Remember I talked about 10, 15, or 25 years? So usually you will not be able to access your money until the plan matures. So imagine you have to contribute 100 until all the way to 25 years. That's a very long time for anyone. even for those in the army and then they get started, you only get your money back when you are married with kids and have a house and everything. All right. So secondly, they have high upfront fees and commissions. That's how the insurance agents are getting paid, right? And this can eat into your returns. Finally, because of the high fees, the returns on endowment plans are usually lower than other investment options. And this brings me to point number 2. Regular savings plans, or RSPs in short, are offered by many banks and investment firms in Singapore. So RSPs allow you to invest small amounts of money on a regular basis, usually monthly, into those diversified portfolio of stocks, ETFs, or unit trusts. For this case, I'm going to use Fund Superfund as a very good example. In this table, you can see that FSM offers more than 40 ETFs, 1,200 unit trusts, and 10 managed portfolios. Managed portfolio meaning they will invest for you for certain management fee. The best part about this whole this whole picture is that they will even spell out the processing fees and the sales charges, which are very minimal from what is shown over here. And you can use FSM to invest directly into the S&P 500 index fund with just a minimum of $50 per month. This is hassle-free and a great long-term investment plan. Actually, it is also advocated by the legendary investor Warren Buffett. In fact, he has shared countless times that investing in a low-cost index fund is a good way for beginners to get started. He himself wants 90% of his wealth to go to the S&P 500 index after he's gone. So by now, you already know of the benefits of RSPs, as they require much lesser time to monitor and forces you to invest regularly. On the other hand, because of this, they will also require you to have the discipline to keep investing regularly even during market downturns. Like if, for example, if there's a recession, you still must continue to put in $100 every month. And you also have to perform the transaction regularly, that means on your own, because there's no gyro option to automate things. This brings me to the third option, Robo Advisors. Quick pause. Weibo just launched a great offer where new users just need to fund any amount and you can get 3 free fractional shares. And by any amount, I mean even a minimum of just $1. If you maintain your funds for 30 days, alright, you will get another 2 free fractional shares. So for those who have not heard of Weibo, they are regulated by MAS and it is also a very popular trading brokerage app based in the US. If you are interested to sign up, I have placed the link down below in the description. With that, let's jump back into our video. So Robo Advisors are digital platforms that use algorithms to manage your investments. They typically invest your money in various kinds of portfolios. For example, they could be formed by just a very simple mixture of 2 funds, one in stocks and one in bonds, giving you a 60-40 asset allocation. And the other popular kind that has been, getting people excited is the ability to invest based on the different themes, such as one is the ESG and clean energy. What it does is that, okay, we're going to use SIFE as an example. SIFE will have a portfolio and it will invest in a basket of ESG focused funds after screening through various criteria. In return, all these funds are vested in all the different stocks you see from the picture over here. Alright, there are plenty of companies like Tesla, United Health Group, BYD, SolarEdge, and more. Okay, personally, I'm also parking my funds into SIFE. If you want me to go through SIFE, in another video, in a step-by-step guide, do let me know in the comments down below. Alright, so I will just prepare and do a video for you. Coming back to the topic, okay, the beauty or the benefits of Robo Advisors is that you can invest based on your risk tolerance level and investment goals. And then everything is quite automated and requires little effort on your part. They will even do the rebalancing for you as well. However, there are also some drawbacks to Robo Advisors. Firstly, they may not offer the same level of customization and personalization as other investment options because they have a certain portfolio, right? And they are invested in all these, so it's pretty fixed. Okay. Secondly, right, their management fees are based on how much you are invested in them. This means that let's say you 100,000 into SIFE already, you will need to pay an annual management fees of 0.4%. This doesn't sound much, okay, since it's below 1%, but for 100,000, it will translate into $400 management fees every year. By comparison, if you pump this 100,000 into stocks at one go, you probably just pay a small commission fee of less than $100. If you go for low cost, brokerage firms like FSM or Tiger Brokers or Usmart, your commission fees are much lower. And this brings us to point number 4, investing in individual stocks. Without a doubt, investing in individual shares is a popular option for many investors. Because by and large, most people probably get into stocks first before they diversify into other things like unit trusts or robo advisors. But you must be thinking, is it even possible to buy stocks with just $100? Well, technically it is possible if you invest in Singapore stocks below $1 because Singapore right now has 100 minimum shares per one lot. But not to be overly worried over here, you can still be spoiled for choice because in Singapore there are over 500 stocks below $1. You can even find blue chip stocks like Thai Beverage, CICT, Genting Singapore, and small cap stocks like Sembcorp Marine, of course. On the other hand, it's more flexible with US stocks as well because you can just buy one single share. Imagine being able to buy shares like Apple, Tesla, Alphabet, and more. So you can actually tap on the fractional shares feature in some of the low-cost brokerage firms and buy exactly up to the $100 mark. So one of the main benefits of individual stocks is that they offer the potential for higher returns, especially if you do the research properly using stock analysis tools like Simply Wall Street. The downside is obvious. Yes, you will lose money since stocks are volatile in nature. And to wrap things up, those are the 4 main options for investing with $100 monthly or lesser in Singapore: endowment plans, regular saving plans, robo advisors, and individual stocks. Each option has its own pros and cons, so it is crucial to consider your financial goals and risk tolerance beforehand. More importantly, think of it in the long term, like the rabbit versus the turtle, right? Slow and steady wins the race. If you find this video helpful, do help me smash the like button and subscribe to the channel. It helps the YouTube algorithm to share with more people who will then like and subscribe to my channel again. Next up, check out this video over here for 5 defensive Singapore stocks with at least 4% dividend yields. And I will see you next time. Thanks for watching and ciao.